So it gets started. We're going to go back to the Forex Bible. Once again, we're going to go to the end now. So on the 3-day masterclass, at the very end, we go through some key knowledge and a bit of planning. So for when they leave the course. So I'm going to take you through that now. I'm going to jump on a screen share. Here we go. So strengths and weaknesses. So at the start of the mini series, we looked at goals. So goal setting, what do you want to achieve? And then went for a bit more technical analysis, obviously risk management, using the right lot size and why that's important. We looked at pips as well. And of course, we looked at some techniques on how you can find some good solid trades just using some really simple methods. Now, once you start practicing these methods, you're going to start to find stuff you're good at and stuff you're not good at, strengths and weaknesses. So what I tend to do on day 3, the aspiring trader, the student, will come and sit down with me and we'll have a strengths and weaknesses little table like this. So we'll write all the strengths and all your weaknesses. And then before they leave, this is the goal. Everything that's in a weakness column has to move over to strengths. And that's what you need to do. So you can screenshot this if you like, or you can make your own one. Anything you find that you're weak at, so whether that's trying to find trend lines, trying to work out what your lot size is, anything like that, put in the weakness column. And that is going to be on your daily self-improvement time slot. Remember, we discussed that at the start of the mini-series. So at least spend 45 minutes a day to an hour minimum on just trying to improve on certain attributes. And that's what you're going to look for. You're going to move your weaknesses over into the strengths column. So for example, if you're struggling to find trend lines, you just practice daily on plotting trend lines, finding them. You can do that by back testing and in the live market. Then once you feel that's a strength, you move out of the weakness column and into the strengths. That way, it's an organized strategic approach of just ticking off those weaknesses, just batting them off and moving them into the strengths column. And that's how you become better. Because as kind of simple as this sounds, no one really likes doing this. But once you do it and you go, do you know what, Ryan, I'm just going to do it. I'm going to write my weaknesses down. Actually seeing what you're bad at written down in front of you is a great way to improve. And you'll have great satisfaction crossing that off the weaknesses list and putting it onto the strengths column. You'll have great satisfaction in doing that. It's like one little mini goal achieved. And then you move on to the next thing. You just move down the weaknesses list and move them across. So that's going to help you guys massively. It really will. There's nothing better than having what you're shit at written down in front of you and getting good at it and then moving it over. Getting good at it, moving it over. And then once you've ticked them all off, there'll be more stuff to load on. I still do it now. There's always some little bits you want to improve on. And it's great seeing it visually. So get yourself a strengths and weakness. Very simple table like this. And I'll guarantee you, hands down, if you do this, take it seriously and dedicate a bit of time, imagine how good you're going to be in 3, 6, 12 months. You'll be absolutely awesome because you've worked on your weaknesses strategically rather than kind of having it in your head, working on them sporadically. Oh, I'll do this today when I'm back testing, or I'll do this today when I'm looking at the charts. Instead of actually going, right, I'm going to just practice this, one of my weaknesses, until it's one of my strengths. Then I'm going to move on to the next thing. And that's how you become good. So let's take a look then at psychology. Just take a look. Okay, so psychology now. Psychology plays a huge day-to-day factor for Forex traders. Understanding your own psychology and how to neutralize certain emotions can only be obtained through experience. However, here is a list of common psychological barriers that Forex traders come across. Now, we had a question yesterday about how do I deal with the emotions? And my answer to that question, it's a great question. My answer to that question was, I can teach you what emotions you're going to expect to come across as a new trader and an experienced trader. And I can also show you how to deal with them. But ultimately, you're only going to get better with dealing with your emotions and your psychology just through experience and just keep on it every day. It's the only way you're going to build up that barrier and neutralize those emotions, which is very, very important, because when you're emotionally involved in a trade, you start making wrong decisions and you're not in the correct mindset to make sensible decisions. So it's really, really important that you stay neutral as possible. So first of all, let's just talk about a few of the main emotions and the main kind of bad habits which traders do, beginner, intermediate traders as well. So first of all, we've got the watcher. Now, be honest, if some of you have experienced this, put it in the comments. If some of you are doing it now, put it in the comments, fire it in. We're all here to share and obviously learn and just improve as much as we can. So feel free to share your experiences. So the watcher, so that's obsessively watching the charts, predominantly on the lower time frames whilst in a trade position. So being a watcher will lead to a very stressful trading experience as well as poor decision making. If you have risked the correct percentage for your trade and you have a stop loss in place, then there is no need to watch each candlestick. And I've been there. I was a beginner once, been watching, make sure this is trade going to go my way. And then you go down to the lower time frames, you're like, oh no, that's a low test. Oh no, it's a high test. Now we got a doji. And it's going to stress you out. Don't do that. Once you've done your analysis, who cares what happens between point A and B? Yeah, just check it every now and then to make sure there's no kind of key reversal patterns happening within your trade. But do not be stressing yourself out, because trading is actually really enjoyable once you build up the confidence, you start gaining that experience, and you trust yourself and your analysis. So becoming a watcher is a really good way to self-sabotage your trades, because one, you end up closing them early. Two, you can even end up closing them and going the other way just because you've been looking on the lower time frames. And you zoom into a little bubble where you're just looking and you don't come back out to look at the bigger picture. So it's really, really important. Next, we've got revenge trading. Now, I'm sure plenty of you have done this, myself included. I think everyone at the start of their journey has that kind of revenge emotion. You lose a trade, you think, I want to get that back. So revenge trading is an aggressive emotion which occurs when you lose a trade. You want to beat the market and get your percentages back. So you start placing multiple trades with little or no confluences. This is a road to losing even more trades, basically. So learn to take the loss, move on as early on in your career as possible. So just learn to move on from that. You've taken a loss, so what? That is part of the process. You're going to get losses. Once you accept that is perfectly normal, and you're never going to have 100% strike rate, it's never going to happen. No one in the history of trading in the world has had 100% strike rate. That's had a trading career. It just doesn't happen. So taking a loss is part of it. There's no need to revenge trade. Reanalyze, step back, remain neutral, and then look to carry on trading. Do not revenge trade. It's a really, really bad trait. It's an easy trait to be sucked into as well. So if you've revenge traded, then stick it in the comments, guys. We want to know. Then after I've gone through this, we can go through and we can just talk about it further. So watching trades and revenge trading are two of the most common psychological warfare attributes, I would say, that suck traders in. Okay, the markets are sucking you in by playing on your emotions. So, and your emotions start to heighten more when you're watching the trade. So it all stems from being a watcher. So let's see what else we got. We got loading the deck. Now this is a massive one for a lot of people. I mean, I've taught hundreds, if not thousands, of people, and so many of them are like, yeah, you know, it looks. I was so sure it was going to go down. So when I came into drawdown, I put more on. It's not going to work. So you've just placed a trade, and the position is now in drawdown. You feel certain the trade is going to come back, so you add another position. The trade continues to progress into further drawdown, so you add another position. This is not a sustainable method of trading, and you can blow your account very quickly. To stick to your original position until it's risk-free, then you can look to add another position. So that's called a scaling. That's a safe way of adding another trade. So once your first trade goes into profit, you can move stop loss to entry. Then when your analysis is saying, yes, you know, we've had a nice push on exhaustion, like I've shown you in the previous episodes, I can add another trade. Brilliant. So you can add another trade and so on and so forth. So loading the deck, once a trade's already in a loss, is not good, because you're literally exposing so much risk of your account to the market. So let's say you start off with 1% risk. You're now trading out 2, you're now at 3% risk just on one trade. it's not going to work. Well, it could work out, but most of the time it doesn't, because what happens when you risk more? You become more emotionally involved in the trade. You start watching it. You start doing poor decision-making skills. You can see how this is a slippery slope. So when you risk correctly, you're not really emotionally involved in the trade too much, because you haven't over-leveraged. That's why the risk percentage is so important. Impulse trading is the next trait. Now, this is caused by not looking at the bigger picture and impulsively taking a trade based on a current price action moving quickly. So stick to your multi-time frame analysis and have no fear of missing out, and you will not have any issues of impulse trading. Now, impulse trading, an easy way to neutralize that is wait for the candle to close. We never trade on an open live candle. Whatever time frame we're going to execute on, we wait for that candle to close, because most of the time you'll be looking at the smaller picture. You see a really big candle, lovely, it's a really nice bullish candle. On going long, what happens? It pulls all the way back, ends up being a high test, and then price goes the other way and stops you out. I'm sure some of you have experienced this before. So impulse trading is where you open up the charts, you impulsively look, that looks good, and you're getting in. You haven't took the time, you haven't stepped back, you haven't done your multi-time frame analysis. Remember, never have any fear of missing out, because forex isn't going anywhere. There will always be another trade. So only enter a trade once your confluences are met, which we went through yesterday, and you can tick those confluences off, and you're like, yeah, great, this trade is for me, it's ticking on my confluences, I'm going to take the trade, I'm going to risk correctly. So impulse trading is also a slippery slope. Wait for the candle to close. That's the easiest way to, one, identify what the candlestick is, because the candlestick's closed. You can now identify whether it's a high test or a low test or a doji, etc. So just wait for the candle to close, and that will neutralize impulse trading. Next one is a huge one, I think, for a lot of people, is over leveraging. So becoming impatient and want to get rich quick may cause you to over leverage, which means risking more than your allocated 1 or 2%. By risking more, you expose more of your account to more risk, and your emotions and decision making will now be affected, as there is a potential larger loss at stake. Over leveraging, we're all guilty of it, and unfortunately we only learn the hard way. However, as I explained yesterday, there is no reason to over leverage anymore, because we've got companies like FTMO that are willing to fund traders. So if you start off with a small account, just focus on making a percentage every month. Even if you've got a £500 account and you're doing 10% a month, it's only 50 quid, right? I mean, that could be a lot of money to some people, but it's 50 quid. Now, yes, that may not be life changing, but think about what you're actually doing here. You're becoming consistent, practicing, okay, with your own money. So there's a bit of motion involved. It's your own hard-earned money. It's not a demo account. You're practicing, and now you're becoming consistent in making your percentages every month. What can you do? You can go and take a funded account challenge. If you pass that, there you go. You've got the bigger capital, and that 10% is no longer 50 quid. You know, if you've got a 50k funded account, you're now going to get 70% of 5 grand. So it soon develops very quickly. That's why there's no reason to over leverage. So all the time you're thinking, I want to over leverage, I want to make more money, just think, this account that I'm practicing on, that I'm trying to become a good independent trader on, is not for me getting rich quick. It's for me to be able to make a consistent percentage every month, so that I could potentially get funded, or if I've got savings, use my own money, etc, etc. There's one thing that I hate seeing is people that have, and aspiring traders that have so much promise, and they're really good, they're showing really good skill set, they're learning very quickly, but because they want the money quick, they end up failing and they give up. And there's really no need for that. And it really does. It breaks my heart, because I think, oh, you showed so much promise, but the money ruined it for you. And the irony of that is just crazy. You're most probably in this game to obviously gain extra freedom, time, and make money. And trying to make as much money as you can straight off the bat is what also threw you out of the game. And put you off, and you walked away. So for me, that's really gutting to see that happen. And it doesn't need to happen. It really doesn't, because your small account that you're going to start off with, and I'll say small account because I recommend any beginner to start off with a small account, because you don't even know if you can trade yet. So just start off with a small account and just practice. Risk correctly. Forget about the money. focus on the percentages. And then once you start building up and you've proven to yourself that you can actually trade, then you can either add your own capital or try and get a funded account. For me, that makes perfect sense. It really does. So here we have a winning mindset. Okay, so this is coming towards the end. So a winning mindset. To be a consistent forex trader and that long-term winning mindset, you need to have a plan. So what is your weekly and monthly percentage target? We went for this in the earlier episodes of the mini-series. Know your exact risk per trade. Are you going to risk 1% for every trade? Or are you going to risk 2% for every trade? Being patient and waiting for the high probability setups as well. Just be patient. Make sure all your confluences are met. Do not force trades for the sake of trading. We don't see nothing for one day. Does not mean your criteria. Step back. Turn off the screens. There's nothing there. Don't worry about it. Or stay on the screens and backtest. Use that day as a practice day. You don't have to work every single day with forex. Honestly, so don't try and trade just because you feel you need to trade. And some days you won't see anything. It's not because there's nothing wrong with you. It's not because there's something wrong with what you're doing. It's because there just may not be anything there. So don't feel like you need to trade for the sake of trading. A big part of trading is knowing when not to trade. And when we're staying out of a trade, it's costing us zero. It's costing us nothing. So don't worry about it. Okay, so good weekly return, 2 to 2.5%. That's solid. Okay, you won't get it every week. Some weeks you'll have losing weeks. Some weeks you'll have break-even week. But 2 to 2.5% a week will change your life if you're doing that every week. This return, a 8 to 10% return on investment per month, which is a very good and consistent, realistic percentage to gain. So when you've become experienced, you've practiced, you've put in the time, you will start to see these returns creeping up. You're not going to earn that in the first month consistently every single month. Okay, it takes time to build up to that level, but once you get there and you're risking correctly, you just got to be patient. You will get there. If you stick at it, you will get there. Okay, make a trade plan. Your trade plan is a tailored plan unique to you and will improve in time. It will outline the do's and don'ts of your day-to-day trading and also have your daily analysis time allocated. It'd be noted down. So you can say, okay, every day, 7 to 8 in the morning, I'm going to do my analysis ready for the day. Or if you're working full-time, when everyone's back at work, it might be 7 to 8 in the evening, for example. So you're just going to have a little structured plan of exactly your confidence is what you're looking for, what you're not going to do, and when you're going to be looking to trade. If you're a day trader, swing trader, scalp trader, and when you're going to be looking to analyze. So it's just a nice little outline to have in front of you. And it works as a bit of a tick sheet exercise as well. You say, yes, confidences are met here, 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 and here. It's all about keeping organized to make it easy for you rather than not having anything written down, being unorganized, going, oh, am I going to take this trade? Yes or no? And then you end up acting a little bit erratic and panicking. You may enter a trade because you didn't want to miss it. You've entered impulsively. And we want to avoid that. You've got to be calm, get a trade plan, stick to it. A trade plan will also have noted down key points of your strategy to serve as a reminder. So again, that kind of comes back to those confluences. Okay. I think we've had some... This is me slowly fading it out now. Jordan, yeah. Is that about the impulse trading? Is that one? I've got my screen time up on my phone for about eight hours one day. Forex to do that. If you're training from your phone, your screen time just goes through the roof. Any questions at the minute about psychology or anything that we've actually learned so far that I can help with whilst we're on this mini lesson? I will put the psychology booklet in, like I just said. So if you joined a bit late, don't worry. I'll be making the booklet together for you guys. And then you can take that away with you and hopefully help improve your trading. We're not going to be jumping on the charts on this one. This is more of a talk about psychology. And if you're going through those emotions at the moment, just remember and realize whilst you're going through them, that's one of the hardest things to do is think, okay, look, actually, I'm looking to impulse trade here. Step back. I'm not going to do it. You know, let the willpower kick in. Because that's a massive part of trading. Just telling yourself, no, I'm not going to do this. If it goes without me, the trade goes without me. I don't care. There will be another trade. And then you've got to do your thing. You've got to stick to your strategy. There's one thing I'll say to everybody, which is really, really important to remember. There's no strategy in the world, which will fit every single market conditions. So your strategy will miss trades and it will catch trades. We're not worried about the missed trades. We're about the trades that the strategy's catching. That's what we're looking at. We're not worried about the missed trades. All the time you're trying to alter your strategy to tailor to every market condition, you end up chasing the market, and then you end up losing, and your strategy actually isn't a strategy anymore because you keep changing it. I think you should increase the subscription for the Golden Suite and keep doing the Zoom calls even after the quarantine is over. No, I won't increase the subscription. You know, it's good where it is. But thanks for the shout. That's my biggest problem, not letting candles finish. Yeah, Ross, I mean, letting the candle close is epic, because most of the time it does actually work in your favour. And it's really, really important that we get that candlestick confirmation. I mean, a lot of traders can enter straight off levels. That's not really my style. I like to see what's happening in the market. I use the candlesticks to my advantage, and it works really well. And it helps you to be patient. So waiting for that candlestick close does help with being patient, and then over time you become a lot more patient and emotionless because you've been doing that every day, waiting for the candlestick to close. I just need to get home and onto the laptop, sick of the phone analysis. Yeah. Oh, you're stuck on a cruise ship, right? In the Caribbean somewhere on lockdown. Phone analysis is difficult. I mean, if you've got a desktop or a laptop, that's going to help you so much because you can really look at the bigger picture. And also, when you got your phone upright, a drop looks really, really big. But really, when you look on a computer, it wasn't actually that much of a big drop. So the phone can actually be really deceiving. So just be careful there. Okay, just be careful there. Okay, so I hope everyone's enjoyed this episode. Tomorrow, we're going to be going for a Q&A. I've got some really, really good tips of what not to do. We are going to jump on the charts tomorrow, and that'll be episode 10 finished, and then they're all going to be on YouTube, ready for you guys to recap. Then I'll also be dropping the booklet out there as well, completely free. All right, so I hope everyone's staying safe and all your family's safe. Take care, everybody, and I'll catch you all tomorrow. All the best.